What's going on? Welcome back. Ryan here. In this video, we're talking about the long call butterfly and the long put butterfly. Now, if you haven't seen what butterflies are or you haven't heard of butterflies, you're in for a treat because this is one of my favorite options strategies because of the risk to reward ratio, because of the flexibility, because of the ease of implementation, and because it is a pretty forgiving strategy that you can consistently make money with, right? And that's limited risk. Okay, so I have Microsoft here loaded up, and we're going to zoom in here. And we can see that Microsoft it almost looks like a head and shoulders pattern, right? Where you have, here's a shoulder, here's a head, here's another shoulder, right? But again, Microsoft is squeezing here. It looks like there's like the squeeze happening, but the momentum of the wave is above zero. So a lot of the time when you see this will end up squeezing and then coming up here and making a new high. So when we think about butterflies, though, butterflies are spreads, and the way that we construct them is pretty simple. So let's come in here to our option chain on Microsoft, and let's just assume, for the sake of the example, that Microsoft is going to continue up towards its mean, and it's maybe even going to come up to the upper band of this one standard deviation, right? So it's going to stay in this area, and maybe we'll look at it at a 333 might be a good center for our butterfly to target. So we could come in here and let's look at 31 days out. And I'm on a PC right now, and when I'm creating spreads inside of Thinkorswim, what I like to do is I like to hold down Control to be able to select different options, right? Look, I can select all these options. Now I can delete them, right? So when we're thinking about, we'll start with the long call butterfly first, okay? Where we think Microsoft's going to continue up. So maybe we don't know how fast that's going to happen, or we're not even sure if it's going to happen. And maybe we think it could even trade sideways, right? Because butterflies can be used as directional, but also to make money with the passage of time, right? Because we're now using a spread where we're buying and selling options. So for the directional play, if we thought Microsoft was going to go up, we could come up here and we'll actually do a 5-point spread. So what we'll do is we'll sell 2 of these 335 calls, and then what we'll do is we will buy the 330 and we'll buy the 340. Okay, so we have a 5-point spread, right? 5 points from 330 to 335 and 5 points from 335 to 340, where the outside wings are one contract, and then in the middle you have 2 contracts. Now, these are long call butterfly, long put butterfly are always going to be debit spreads. Okay? So, and when we think about the risk on these trades, remember, when we think of the risk on these butterflies, it's always going to be the width of the spread, right? So a 5-point spread, and then how much our debit is going to be, right? So on this trade, if I tried to get this filled at, let's just go down here and get at the bottom of this range, 60 cent debit, right? If I look at this 60-cent debit, it's showing me that, okay, I'm paying $60 for this spread, right? So 60 cents, 60 cents times, these are 100 shares, remember, right? So the risk on the trade is 60 bucks, right? Plus our commission. But our max profit on this is $440, right? So think about that. $440 divided by 60, we're like getting 7-to-1 on our money on this trade, right? This could be an extremely lucrative trade when we think about the risk to reward profile. Okay? Now, again, when we think about the risk on spreads, how do we actually get that 440 max profit? Well, remember, it's a 5-point spread, and our risk on that is 60, right? So 5-point spread times 100 shares, okay, and then we minus our 60 on that, and that gives us that 440. Okay, so another way to look at this is it's $5 like this, and then we minus that 60 cents, right, that we pay, and that gives us that 4.4 times 100 shares, which then gives us that max profit. But let's actually take a look at what this looks like, right? So if we keep it at that 60-cent debit, and now we hit analyze trade, we're going to get this type of graph here where the center part of this butterfly is at 335, right? So again, above the market, right? We're looking at this as like a kind of a bullish play here, and we can see that here is where the price of the market is. And this, again, the blue line is the intrinsic value of the option at expiration, and the purple line is the time value. And remember, we did this on this has 31 days of time. So when we start to step through this, right, if we actually go back to where we are now, which is 21st, when we start to step through this, we can see that as time goes, this purple line is going to approach that blue line, where if this asset is near this 335 middle short strike, that we would be able to then sell this for 153 bucks, right? As it gets closer, you're able to then capture the decay of those middle options and the intrinsic value of the wing. Okay. Now, another way to think about this is, let's just think that maybe we think that this isn't going to go up and it's not going to go down, and it's just going to trade sideways, right? So another way to do this is, instead of creating that spread above the market, what we do is we just do something like this, where if we just thought it was going to stay around 325, again, we could sell 2 of these, and then we could do our 5-point spread, right? So we would buy the 320, and then we would buy the 330, and again, we'll do this just one contract, right? So if you see the way I can make more than one contract, it's always going to be where the outside wings are, it's 2-to-1, right? Because these butterflies are actually 2 different spreads put together, right? It's a call credit spread and a put credit spread combined together, which we're going to look at when we get to the vertical spreads. But just know how this works, right? Where we're buying 2 of the middle, then we're buying 1 of the outside wings, where the wing is equidistant from the center. So again, there's a wide range here on this bid-ask spread, right? Which this is key here, because the lower that you can pay a debit out of pocket for a butterfly, the better risk you're going to have, right? So let's take a look at this. If we buy this for a $2.20 debit and we analyze this, look at what this looks like, right? We can lose $220 here. We can lose this money if the asset gets outside of here, right? On the other hand, when we come in here, if we were to be able to get this for an 80-cent debit, right, the lower end of that bid-ask spread, right, again, look, much better risk to reward, right, where we're only going to lose $80 on this, but we have the ability to make almost $400 at expiration. Now, one of the most important things to understand is a lot of the time these butterflies, you're not going to be targeting them to make the full amount, right? A lot of the time you can just capture, 10 to 50% of the value of these and still close them out for a winner, right? Which, important to understand that, again, if you have the choice of, let's just look at the culture of Wall Street bets, right? Some people YOLOing $500,000 into these short-term options as buys. Think about what type of risk to reward profile you could create if you did the same trade but used a butterfly, right? So let's just think about that, right? Somebody thinks that they're convicted that Microsoft is going to move back up towards this $330 level. So we could come in here and again, 330, we could sell two of these, and then we could buy the 25, the 325, and we could buy the 335 on top. And maybe we'll just try to do this for we'll try to do it for a 60-cent debit, right? So on $600, right, which is going to be 10 of these, it would be risking 600 to make 4,400. Now let's see what happens if we do 100 or 1,000. Let's put 1,000 in here and see what that looks like, just for fun, right? Okay, so here's you could do 1,000 of these, right, for $60,000. That would be your risk, right? You'd be paying $2,600 in commissions. But now let's look at what this actually looks like, right? So here's your risk of $60,000. Let's go back here to where we are now. And we could see that if this just were to stay the same as this passage of time happens, right, when we start getting into the last days of where this is, you could basically put that $60,000 up, and when this starts to erode away, right, this could pay off, right? And you might not even need to hold it till expiration, and for it to yield a profit for you. And you don't necessarily need to be right on the direction, right? There's quite a bit of play here where the market could fluctuate inside of this butterfly and you can still make money. And that is the power of understanding the way that these things work. Now, again, we're talking about long call butterfly, right? Where I've come in here and I've constructed the butterfly using the calls. But it's important to understand that the long put butterfly is the same risk and it looks the same. So again, if I thought it was just going to stay here, I could sell two of these 325s. I'll buy the 320 and I'll buy the 330. Oh, that didn't turn out right. So sell two of those, buy this, we'll put this in the middle. So maybe we paid $1 on this one, right? So we come in here, and again, it looks the same, right? This is important to understand that the long call butterfly and the long put butterfly, where you're selling those middle strikes, you're buying the wings, that the call side and the put side both look the same, right? The P&L graph here looks the same. Now, why would you choose puts versus calls when you're doing a butterfly? Well, I guess that has to do with your assumption of what the market's going to do, right? Because you could do a butterfly like this where if for whatever reason you thought that this Microsoft was going to come down here and touch, maybe you thought it was going to make a really outlier move, right? It was going to start trending downwards for whatever reason, right? And you looked at the bottom of this 3 standard deviation band, and you even said, here, look, the ATR is saying that this could move up or down $7.95, right? So where it is now, 327. So maybe you think it's going to come down here to 320, right? Well, you could come in here, and obviously I would say instead of putting the call down here, right, you could do this where you would put the call down here and have it come back down, but better to do it with the puts, right? I mean, you could sell 2 of these, and let's do a wider butterfly. Instead of 5 points, we'll do 10 points. So right, so we'll do a 10-point butterfly, and you can see the debit is going to go up, right? Because now the spread is wider, right? So let's hope we could do that for $1.50, right? What does this look like? So you're risking $1,500, risking $1,526 to make $8,500 on this, right? So when we now look at placing a butterfly below the market, right? We're placing this put butterfly below the market, anticipating that Microsoft could fall inside of this butterfly. As time goes by, right, the butterfly, the P&L on this is changing because of the passage of time, right? Because we're constructing this spread where we're buying options and we're selling options. Okay, so really important to understand, how you can use this software and these option spreads and these strategies, right, to really construct trades that have superior risk to reward, right? Think about it. You could take $1,500 and you could buy $1,500 worth of stock or something, but you could also use that $1,500 to put on, a put or a call butterfly like this, right? Which is a debit, right? You're paying this debit, but your risk to reward on this is superior because of the type of return it can produce on the cash invested, right? Again, you're talking about, easily making over 100% should this trade play out perfectly, right? Important to understand, right? There's no guarantees. Just as easily as we make the assumption that Microsoft could go down, Microsoft could just as easily rally and we would lose our $1,500, right? So really important to understand there's no guarantees, but when we're looking at these trades, when we're looking at specifically the long call butterfly and the long put butterfly, they give us tons and tons of flexibility for the market not doing exactly what we think in the time that we think that it's going to happen, and we still can make money, right? So one thing I want to talk about where you could potentially lose money, right? So obviously let's take a look at another scenario here, right? Where instead of selling 31 days out, let's look at selling only 10 days out, right? So if we thought that this just wasn't going to move, we could come in here and let's just do the put butterfly right at the money, right? We sell 2 of these 325s, then we buy the 320 and we buy the 330, right? So we have our butterfly. And again, maybe we'll just target this for $1 debit, right? So we're risking, it's a 5-point spread. We're risking $1 to make $4, right? So again, with 10 contracts, that's risking 1,000 to make 4,000, right? We have to include the commissions. But one of the important things to realize is, okay, when we analyze this trade now, oh yeah, that's why. So the time was outside of the expiration here. So we're on the 21st. And again, we want to open this up and see that, okay, we could lose $1,000 on this if it's outside of these at expiration. But as time starts to move forward, right, there's 10 days. So this option is going to expire on the 31st of December. So when we're analyzing this, we can see that we can step through these 10 days, right? So 1, 2, 3, 4, 5, 6, 7, right? And in 7 days, you will start to make money on this, right? If the market stays in between this little area here, right? Which is the outside of the wings, which is 330 and 320, right? 5-point spread. So this needs to be below the break even here, which would be 320 here and 329 here. But as this approaches its expiration, these are going to erode away. Now, the reason why I'm bringing this up with the shorter time on these is you're going to get in trouble if you hold this until expiration and you're not aware of potential assignment of these short middle strike options, right? Because if depending on where this were to settle, where settlement would occur, right? When these option prices close, it's settled. Now you're looking at assignment. It's just never a good idea to hold these into that period because you don't want that unnecessary risk of assignment on the underlying when you were just trying to capture a percentage of, that $1,000 you put up, right? So again, if you had the chance to close out this trade for, let's say that you close this out for $600 winner, right? You put up $1,000, you put this trade on, and in 10 days, it produced a 60% gain on your cash, right? You put up $1,000, now you could cash this thing out and you'll get $1,600 back, right? Which is your $1,000 you put up for the debit, plus that $600. Like, that's a winning scenario every time you do it, right? And because you have the flexibility to not necessarily be right with your assumption of the market, these long call and long put butterflies become very, very, very lucrative instruments, especially when you start looking at scenarios of like, okay, if I were to become a money manager and I was managing $10 million, these are the type of trades I would put on to manage risk correctly. Because think about it. If you have a $10 million account and you're using 1% of risk per trade, that means that you could put on a butterfly like this for $100,000. Think about this, right? Think about what that means, right? So if let's let's give a little bit more time, 17 days. If we think that, again, if we think that Microsoft is going to trade and stay in its 68.2% zone here, and again, we could target this 330 level, right? But now we have a $10 million account. What does that actually look like in terms of numbers when we think about the risk, right? So we're selling to the middle again. We're constructing our 5-point wide spread, right? And let's just keep it at a flat debit of $1, and we'll do 1,000 of these, right? So, okay, perfect. If we do 1,000 of these, right, here's our max loss, $100,000. $2,600 for the commissions. But again, our risk to reward on this 5-point spread is if we were getting this for $1, it'd be we're risking that $1 to make $4. Now, obviously, it would be better if we could get this for a cheaper debit, because then we would have much better odds. Right now, we're betting less money to make more money, right? So when we look at this, if you had a $10 million account and now you're creating a constant inflow of capital for your investors, right? And you're using these butterfly debit spreads, right? The long call butterfly, the long put butterfly. And we're not quite sure what the market's going to do, but we might be certain, we might be positive that it could stay within this range. Well, we could put this trade on, and again, when we step through this, within a very short amount of time, you could close this out for substantial capital on cash invested. And that is the importance of, digging into these strategies, right? Understanding their use case, understanding how we look at them, how we analyze them, looking at the different risk, and being able to use the software to visually understand how these work, and give us the confidence to actually use them. Because obviously the amount of leverage here, right? If you're putting on this leveraged position with a butterfly, obviously not every person is going to have the risk tolerance to jump in and obviously trade this type of leverage, right? You're more looking at, when you first start, you just do one of these, right? Where your risk is only $70, right? If you do one of these, right, your risk is $70, and you could make, potentially $400, right? And when you're growing small accounts, right, no matter what level you're trading, whatever your risk tolerance is, however big your account size is, these butterflies can be instrumental in helping you grow your account, to create income, to manage that risk, to practice having a plan, and then obviously understanding how these option strategies work. So I think I've talked for quite a bit on the long call butterfly, long put butterfly. If you have any questions, again, please reach out to me. I love hearing from you. Let me know what you think. Again, if you have any questions, reach out, and I will see you in the next video.